How much can you put into an IRA or a 401k or even an HSA, any tax shelter, in 2021? Well, I've got that update and more coming up. My name is Mike Bernard. I am the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. You might want to share this one too because we're getting close to the end of the year, end of 2020. Thank goodness. Looking forward to 2021. It's got to be better, right? And so what should you be planning ahead right now for contribution limits to your tax sheltered accounts? So the 401k, the IRA, the Roth IRA, the HSA, how much can you contribute to those accounts? Has that amount changed in 2021 so that you can plan for your cash flow? I got some bad news on that. But just for perspective, let's go back 20 years. And for some of us, that seems like forever. And for others, it seems like it was just yesterday. That's my camp. I feel like it was just yesterday. The 401k contribution limit, and same with 403bs, back in the year 2000 was $10,500. That's it. And if you wanted to do an IRA or a Roth, you could only put $2,000 in there. And there was no catch-up. So that's pretty incredible that way back, 20 years ago, which again, doesn't really seem that long ago, those contribution limits, just $10,500 to the 401k with no catch-up and $2,000 to an IRA or a Roth. So in 2021, what are those contribution limits? Well, there's mostly bad news, a little bit of good news, mostly bad news. The bad news is, I'm going to run through them in just a second, but no significant changes. Unfortunately, no significant changes to what you can contribute to 401ks or IRAs and Roths, a little small change to the HSA. I'll go through it here in just a second. But so that's the bad news. Especially this is on top of, there was some legislation getting kicked around in the first half of the year when we were dealing with COVID and all of the stimulus. And now, of course, stimulus is stalled and we'll probably get one next year, but there's not one in sight right now. But there was, back in the spring, when there were lots of other proposals, there was a proposal to actually triple contribution limits to 401ks and deferred comps and 403bs. There was also some legislation being kicked around to double HSA contributions. Now, I'm a big fan of this because, again, if you go back 20 years and you were looking to save aggressively, you didn't have a lot of options to do so where you got some tax benefits. Today, most of us are not contributing the maximum amount to even take advantage of all of the tax shelters that we have. But those of us that are, it would be great to have other options or be able to contribute even more to those tax shelters. So the bad news is there's not much change for 2021. I'll go through the limits here in just a second. And especially because there was lots of talk in Congress about increasing these limits significantly, and that's fallen flat. It's not going anywhere. The good news is the income amounts that you can make and still be able to contribute the maximum amount to these or get retirement savers credit, my favorite tax credit out there, did go up slightly. So let's dive into this. I'll share some links below. We'll share some stuff on the screen as well. So for 401ks, and this also applies to 403bs as well, your contribution limit for 2021 is the same as 2020, and that is $19,500 for anyone, and that of course is capped. If you only make 10 grand, you can't contribute $19,500. So it's capped by your income, but $19,500 is the limit. And if you're age 50 in the year you turn 50 or older, you can do a catch-up contribution of $5,500. So if you're age 50 or older, your limit is $26,000 to your 401k or 403b, but for everyone else, your limit is $15,500. So no change there. If you have set up your contribution limit for 2021, or excuse me, your contributions to your 401k in 2021 to reach that maximum, really there's no change that you need to make. There might be a change if you're seeing an income change, right? So oftentimes we're adjusting those around this time of year. If you're not contributing the maximum, then I would tell you, as I do every year, increase your contribution percentage by just 1%. increase your contribution percentage by just 1%. If you're not at the maximum, increasing by 1%, you're not even going to feel the change in your cash flow, but you will absolutely feel it when you're 65, when you're 75, when you're 85. So make that change. Are you contributing to an IRA or a Roth IRA? If you're not, I would encourage you to work with your certified financial planner. See if you should. Big benefits. I love the Roth IRA, but obviously it's circumstantial. Sometimes the IRA is better than the Roth. But the contribution limits for those, if you're younger than age 50, and again, you've got to have earned income. Social Security income and pension income, that's not earned income. Capital gains, not earned income. You actually have to be working. You've got to have earnings, W-2 earnings or self-employed earnings. And your contribution limit in 2021 is the same as 2020 at $6,000. No change there. In the year you turn 50 or older, you can add an extra $1,000 of catch-up. So if you're 50 or older, your limit is up to your wages, okay, but it caps at $7,000. All right, so no change there to IRA or Roth. For me, I have those on autopilot as well. I've got a video coming up about how to automate your savings and so on, but I would set that up on autopilot. And you know, if you're younger than 50, $500 a month. $500 a month. Just set it and forget it. You'll have to do the math to make sure you do that and get your catch up if you're 50 or older, but set it and forget it, IRA and Roth contributions. All right, what about the HSA contributions? And if I could rearrange the order, I'd talk about the HSA first, because it's the only thing in the tax code where you can get pre-tax dollars in and then avoid paying tax on the way out. It's the only one out there. The traditional IRA and traditional 401k, you deduct your contributions on the way in, so it's pre-tax in, but then you've got to pay the tax on the way out. For the Roth, there's no deduction on the way in. Does not help you when you contribute to the Roth. It's just when you pull it out, you don't pay taxes. So the growth is tax-free. The HSA gives you both. Now, the only stipulation is, well, you've got to use the money for medical expenses. Well, you know, we're going to be talking about inflation here on a video. Health insurance and health care is skyrocketing in price. So pretty good odds you're going to spend this money on health care at some point in your life. So the contributions for those of you that have a high deductible health plan, you've got to have a qualified and HSA eligible high deductible health plan, okay? And if you have that, you know, right? If you don't know, just ask your HR professional or go check online. But it's got to be a qualified HSA eligible high deductible health plan. If so, your contribution limit went up slightly in 2021, Right now, for individual coverage, the limit is $3,550. It's going to go to $3,600 in 2021. For family coverage, you just double that. So you're going from $7,100 in 2020 to $7,200 in 2021. If you're age 55 or older, there's a $1,000 catch-up on that. You can do an extra $1,000. Why age 55 when the other catch-ups are at age 50? I have no idea, just to make it confusing. I hate that idea. If you're going to call it a catch-up, especially, match the age, should be 50, okay? So make sure you set up your contributions to your HSA to be automatic as well. If you have the ability, contribute as much as you can out of your paycheck. Out of your paycheck, the contributions to your HSA avoid federal and state tax, but it also avoids FICA. Those wages are not reported to Social Security Administration, so it doesn't help you with your Social Security, but it likely won't hurt you that much, but it avoids the 7.65% Social Security tax if you contribute directly out of your paycheck. If you don't contribute out of your paycheck, or you own a small business, you're not allowed to do that, you just write a check, then you writing that check, it's a deduction on the front page of your tax return, saves you federal and state taxes. Tax shelters are one of the most beneficial ways that you can save up for your financial future. Getting any sort of benefit from the IRS helps you keep more dollars in your pocket, helps you have those additional dollars grow compounded, and helps avoid Uncle Sam from reaching his hand or her hand into your hard-earned money. So take advantage of these. Now, those are your limits. Which of those should you go after? Which of them should you max out? Which of them should you avoid? That's a discussion with your certified financial planner. This is where you need financial wisdom. They're all good. They're all good options. I don't know which one's great. Depends on your goals, depends on your entire situation. Work with your certified financial planner to get that wisdom. If you don't have a CFP that's helping you figure out which tax shelters you should go after, which ones you should max out, and pushing you to help you reach your financial goals, contact a member of my team. We've got a full team of CFPs all working together with our CPAs and insurance professionals. Let us know how we can help. Find us online, corehorn.com. That's Corehorn with a K. wisemoneyshow.com. You can find us there as well, or shoot us an email, info@corehorn.com. All right, there you have it. Go out and take your next wise step in your financial life.